Good morning. Let's kick off with the morning report. Driving markets, driving while talking about markets. So markets are overvalued. Okay. Inflation came in lower than expected, pushed up equity markets in the US, in the Far East, in Europe, and in the UK. It's as if the market is looking for some more good news to maintain its momentum. Remember, I said over and over again, as long as this market has momentum and wants to move up, it will disregard and ignore any particular bad news. And that's what's happening. Any bad news or any semblance of bad news is disregarded. The market's just moving up. So where are we going from here? So if headline inflation is moving down and core inflation is moving down, that's great news because the Fed will not, or the central bank in the US, the Fed will not have to increase interest rates. Now, we're already at the top of the cycle of interest rates. The markets are fully aware of that, and therefore they're pricing in what's going to be happening over the next 6 to 12 months. And as far as they're concerned, they see markets rising now that inflation is dropping and now that interest rates have peaked. Interest rates are unlikely to go up much higher. Okay, in the US, you might have another two interest rate rises of 25 basis points, maybe three, in my opinion, by the end of the year. That'll be it. That's capped out, topped out at that level. Not because the Fed doesn't want to raise rates more. The economy cannot absorb any more interest rate rises. Full stop. Now, in the UK, though, you've got rising interest rates. Probably rates are going to go to 6%. Some views are saying 6.5%. I find it unlikely that we're going to go to 6.5%, more like 5.75 to 6% in the UK, because inflation there is high. Wage inflation is super high, running at the 7.6 or 7.7% wage inflation. Super high, and that's going to concern Andrew Bailey and the MPC, the Monetary Policy Committee, when it comes to making interest rate decisions. Now, wage inflation is rising across the board because of full employment. When you have full employment, shortage of supply, which is manpower, high demand, then you're going to have full employment, you're going to have high wage inflation, and that is going to concern the central banks. So that's something to keep an eye on. Looking at foreign exchange markets, I said over and over again that cable pound dollar is going to go to 130. It's touched the 130. I've been talking about this now since it got all the way back to 122. And now the big test is at 130. Is it going to come off, go down? Is it going to continue rising? It all depends if it can hold on to the 130 level. If it holds on to the 130 level, you could see cable at 132, which is the highest been in more than 12 months. So the reason being is not raising interest rates in the US, rising interest rates in the UK, and therefore you're going to have cable pound favored after money's going to pile into the UK and obviously going to buy the currency as far as that's concerned. Gold. Now, gold is a surprise one because gold went all the way down to 1,910, then bounced aggressively up to 1960 level. So gold traders are thinking, where are we going from here? So the next level is 2,000 if it maintains its momentum, even though the overall trend line was down. So it's got to stay at the 1970 level upwards before testing the 2,000 moving up. Long term, I am a fan of gold. Not on a day trade, not on a swing trade. Long term, I'm a fan of gold, and I think gold will go to 2,200. Overall, markets are overvalued, in my opinion. Markets need to come off in the near term 5 to 6% as an immediate correction, and I think we're going to see a major correction in 2024, around about 25 to 30% drop in financial markets. Why? Because as interest rates bite into the pockets of the individual, and as more and more people are laid off with rising unemployment, then you will see the corporate earnings will be impacted and affected. And as a result of that, you'll see the markets going down because analysts will have to downgrade those particular companies on their future earnings. Microsoft, for example, is laying off more people. So it's not, in addition to the 10,000 layoff at the beginning of the year, it's laying off more people. Yet Microsoft is making huge amounts of money. So the tech sector is where the markets have been driven up since 2010. And now that is what's going to drive the markets down. Remember, the tech sector is a narrow-based growth sector based on the top 7-8 companies in the NASDAQ. And the tech sector is fully valued, if not overvalued. My opinion, it's a bubble, and it's a bubble that's growing, ready to be popped. Okay, so the Nasdaq and the tech sector are ready to be popped. Not at this particular moment, but it will happen over the next, I would suggest, 6 to 8 months. Again, going back to 2024 is where we could see that major correction. 2023 is where the markets want to see an absolute growth in Wall Street and in the indices in order to show their investors that they've made money this year. So Bitcoin now 30,500, 30,600, solid there. Looks like waiting for the next move up to 35,000. That's my view on Bitcoin and the crypto sector. Overall, I see that we're completely overvalued and we are going for a major pop. The bubble's forming, very similar to what happened in 2000 dot-com crisis, very similar to the banking crisis 2008. This is Meir Volensky with Driving Markets. Share, subscribe, comment. Any questions you have, you can DM me. You can follow me on Instagram. Catch you later.